What if I told you there's an investment paying around 5% today with far less drama than stocks? In 2025, bonds are back, offering income stability and long lost relevance in your portfolio. Whether you're 25 or 55, understanding bonds could make you a smarter investor this year. So let's break them down. I'm Matt, a chartered accountant, and in this video, I'll walk you through what bonds are, how they work, and why they might deserve a place in your portfolio in 2025. We'll unpack yields, type of bonds, risks, how to buy them, and what's happening in the bond market right now. This isn't just beginner basics, it's a complete engaging guide to making smarter bond decisions. So let's dive in. So firstly, what are bonds? A bond is a loan from you to the government or a company. In return, they pay you interest, usually at a fixed rate, and then repay your money when the bond matures. Think of it like a savings account that pays you interest, but with price movements in the middle. Here's the key. Bond prices and interest rates move in opposite directions. When rates rise, existing bond prices fall. When rates fall, bond prices rise. And that matters because in 2025, rates are elevated, which means bond yields are finally attractive again. Let's understand yields and duration. The yield is what you earn and it changes based on the bond's price. For example, if a bond pays £50 annually and costs £1,000, that's a 5% yield. But if the price drops to £950, your yield is now 5.26%. Duration measures how sensitive a bond is to interest rate changes. The longer the duration, the more your bond's price will swing. If you're holding a 10-year bond and rates rise, say 1%, your bond might lose 8 to 10% in value. Shorter term bonds are more stable. Let's talk types of bonds. Firstly, you have government bonds, say UK gilts or US treasuries. These are very low risk, lower yield, and they are great for safety. Corporate bonds, on the other hand, are high yield, high risk, issued by companies. Municipal bonds are tax-free income in the US. Emerging market bonds are high yield, high risk, and they have currency and political risks. Inflation protected bonds like TIPS adjust with inflation, preserving purchasing power. You can access these directly or through bond ETFs or funds, which we'll cover shortly. Let's talk about the bond risks that you must know. Firstly, you have interest rate risk. When rates rise, bond prices fall. You also have inflation risk. If inflation outpaces your bond's yields, you lose purchasing power. You also have credit risk. Companies or governments can default. You also have reinvestment risk. If your bond is called or matures, you might have to reinvest at lower rates. Understanding these risks help you decide what duration and quality to invest in. Let's talk bonds in your portfolio. So the 60-40 strategy, traditionally, investors use a 60-40 portfolio. So 60% stocks, 40% bonds. Stocks bring growth, bonds bring stability. In 2022, both crashed, but by 2025, with bond yields at 4 to 5%, many experts say the 60-40 is alive again. For younger investors, they may want to use 10 to 30% bonds for stability. Middle-aged investors might go for 60-40 or 70-30. Whereas for retirees, they'll often use 50 to 70% bonds for income and capital preservation. Let's compare bonds versus other asset classes. So comparing them to stocks, bonds are less volatile, but they do offer lower returns. They shine when markets crash, however. In terms of the comparison against real estate is inflation protected, but it is illiquid. Bonds are far easier to trade. Against cash, bonds lock in a yield. Cash is flexible, but it loses value with inflation. In 2025, with cash yields likely to drop if the Fed cuts rates, same for the Bank of England, locking in bond yields for 2 to 5 years may be a smart move. So how do you buy bonds? Firstly, you can buy these direct via brokers or platforms like Treasury Direct in the US or NS&I in the UK. You can also buy them in an ETF or a mutual fund. These are easy, diversified, tradable like stocks, and are great for beginners. Or through bond ladders. You can buy bonds maturing at staggered intervals, say 1, 2, 3, 4, 5 years. This smooths the reinvestment risk. For most investors, they start with bond ETFs, such as Vanguard Total Bond Market in the US, or the iShares UK Gilt ETFs for the UK. So in terms of the bond market as of 2025, here's what's happening right now. US and UK yields are near 15-year highs, around 4 to 5% on government bonds. Inflation is cooling but still a bit sticky. Real yields are now positive. The Fed and Bank of England paused rate hikes in late 2024, but there are potential cuts in late 2025. The yield curve is flattening, which could signal a soft landing or mild recession. So that's why many investors are buying longer term bonds now to lock in high yields before central banks cut rates further. Here's the tax considerations. For UK gilts, interest is taxable, but no capital gains tax if it's held to maturity. Remember, you can hold bond funds tax-free in an ISA, which is great for high-income investors. In the US, you have munis, which is tax-free federally, sometimes state-free, which is ideal for taxable accounts. Here's a quick tip. If you're in a high tax bracket, hold taxable bonds in your ISA or SIPP and use taxable accounts for lower yielding or tax advantage bonds. So which bonds are right for you? If you're an income seeker, look at high-quality corporate bonds or short-term bond funds yielding 4 to 6%. If you're risk adverse, stick with treasuries or UK gilts, which have a 1 to 3 year duration. If you're a long-term diversifier, a mix of global bonds as well as some high yield and duration between 5 to 10 years is probably the most sensible. The key in 2025, don't chase yield at the cost of quality. There's decent income now, even in safe bonds. Bonds are no longer boring. In 2025, they offer something we haven't seen in years: real income, real diversification, and real opportunity. Whether you're a beginner or an experienced investor, understanding bonds can protect and grow your wealth. If you found this video helpful, hit like and subscribe, and comment below, are you adding bonds to your portfolio this year? Let's chat in the comments.